Dinar shift. Imagine the scenario: you walk into the sleek, modern lobby of your local bank, your heart carrying the weight of anticipation, and the carefully preserved packet of Iraqi dinar notes clutched securely in your hand. You approach the counter, present the foreign currency, and the teller, after a moment of scanning, delivers the phrase that stops your momentum cold: "I am sorry, but we cannot accept these notes at this time." This profoundly disappointing moment, though frustrating, is a reality that countless holders of exotic currencies like the IQD, Vietnamese dong, VND, and Zimbabwean dollar, ZWL, have faced throughout 2025. It is an emotionally draining experience, yet it is crucial to recognize that this rejection is not a final failure. Instead, it is a clear directional signal, indicating that a more strategic and informed approach is required to navigate the rapidly changing landscape of global monetary transactions. The true opportunity lies in understanding the complex mechanics behind the refusal and adapting your preparation accordingly. The root cause of this increasing friction at the teller's window is directly tied to a massive, ongoing transformation within the global financial ecosystem. This isn't random; it's a structural adjustment fueled by sweeping monetary reforms, the rapid integration of advanced regulatory controls, and a fundamental technological shift in how foreign note redemption is verified and executed. We are seeing central banks across the world dramatically tighten their anti-fraud frameworks and elevate their security standards. These institutions are acting under intense pressure to fortify their defenses against financial crime and regulatory non-compliance. Banks that process foreign currency must adhere to these elevated standards to avoid severe penalties and exposure. For holders of so-called exotic or non-major reserve currencies, this global tightening translates directly into a higher barrier to entry when attempting to process their holdings. Understanding this macro-level shift from preparation to strict compliance is the foundation of any successful strategy in this modern environment. This period of intensified scrutiny, particularly throughout 2025, has led to notably higher rejection rates for notes like the IQD, VND, and ZWL. It is vital to separate fact from speculation regarding these refusals. Contrary to common online speculation, these rejections are almost universally rooted in very real, stringent financial safeguards, not in abstract conspiracy or institutional malice. Global financial institutions have significantly upgraded their verification technology. Their currency processing departments now utilize high-grade scanners, advanced anti-counterfeit hardware, and sophisticated AI-enhanced recognition tools designed to inspect every microscopic detail of a currency note. This heightened level of technical scrutiny means that even minor inconsistencies or notes from specific, decommissioned series can instantly trigger an automated rejection within the bank's processing system. A prime example of this technical rejection is the treatment of certain historical currency issues. Iraqi dinar notes printed before the year 2003, which were officially demonetized following the fall of Saddam Hussein's regime, are instantly and correctly declined because they are no longer recognized as legal tender. Similarly, older paper-based Vietnamese dong notes that do not align with the country's current polymer-based system are often rejected by automated systems that prioritize the security features of newer issues. In the case of the Zimbabwean dollar, particularly the high-denomination bearer checks from the hyperinflation collapse, these are now typically categorized as historical memorabilia rather than official legal tender within modern banking systems. Beyond the physical notes, global anti-money laundering (AML) and Know Your Customer (KYC) regulations compel banks to only accept currency that adheres to the absolute highest standards of authenticity and corresponding documentation. Institutions that lack direct, compliant relationships with the issuing central banks, such as the Central Bank of Iraq (CBI), the State Bank of Vietnam (SBV), or the Reserve Bank of Zimbabwe (RBZ), will frequently reject redemptions outright simply to mitigate systemic risk and regulatory exposure. One of the most common pitfalls for foreign currency holders confronted with a bank rejection is the immediate assumption of institutional incompetence or error. While banks are certainly not immune to mistakes, the burden of proof in the sophisticated 2025 financial landscape has shifted to rest more heavily on the currency holder. Before reacting to a rejection by confronting a teller or filing a complaint, a complete and detailed verification of the notes themselves is an essential, mandatory prerequisite. This involves a physical inspection of every bill for crucial security features, checking for the correct crispness, identifying authentic watermarks, tracing the embedded security threads, confirming the presence of micro-printed markings, and verifying proper serial number formatting. Even subtle physical issues, such as slight wear on the edges, fading ink, or light creases, can be enough to trigger a mechanical rejection from automated processing hardware. The security requirements differ significantly across various notes. For instance, post-2003 Iraqi Dinar includes advanced anti-counterfeit features, such as color-shifting ink and clear security bands designed to deter forgery. The modern Vietnamese dong relies heavily on durable polymer material, which features transparent windows that were absent in earlier paper-based issues. Zimbabwean notes, given the complex history of demonetization and currency restructuring, require a particularly high degree of specialized scrutiny to determine their current status as legal tender versus collector's items. Fortunately, the era of relying on visual inspection alone is over. New technology now empowers investors to verify authenticity through digital tools or specialized professional third-party grading services. Entities like the Paper Money Guarantee (PMG) and the Professional Coin Grading Service (PCGs) can issue formal authentication certificates. These professional certificates significantly enhance a holder's credibility and documentation when approaching a redemption process. In the highly technical and regulated current environment, comprehensive third-party verification is no longer a luxury. It is the first mandatory line of defense for your asset. Once the authenticity of your notes has been definitively confirmed, the next strategic imperative is to thoroughly understand the specific policies of the institution you are dealing with, particularly concerning exotic currencies. Many investors incorrectly operate under the assumption that all major banks adhere to a uniform, universal set of foreign exchange guidelines. This belief is now fundamentally outdated. Every single financial institution designs and structures its foreign currency department uniquely, driven by internal risk tolerance models, specific compliance thresholds, and the established international partnerships it maintains with foreign central banks. It is a frequent reality that personnel at a local retail branch level often lack the necessary authority or the specialized equipment to process exotic notes, even if the bank's larger corporate divisions maintain the capability. This institutional layering is precisely why targeted, well-researched questioning is absolutely essential to avoid wasted time and premature frustration. Your interaction with the bank should begin with direct, strategically framed inquiries. Start with simple, factual questions. Is your institution currently processing Iraqi Dinar or Vietnamese dong? Follow up by asking about their back-end infrastructure. Do you maintain an active and compliant redemption framework directly with the CBI or the SBV? A crucial question for the prepared investor is, does your institution accept notes that have been professionally authenticated and certified by PMG or PCGs? Finally, request an official record. Could I please request a written copy of your foreign currency redemption policy for my records? Obtaining written confirmation is a powerful step. It provides you with leverage, anchors the bank to a specific internal procedure, and protects you against potential contradictory statements that might arise from different personnel. Understanding the bank's operational policies transforms a no from a barrier into a set of necessary logistical constraints. It is also important to recognize that major financial institutions, such as Chase, Wells Fargo, and TD Bank, often maintain highly specialized currency divisions. These high-level departments are typically reserved for private banking clients or individuals who meet specific high net worth profiles. These internal separations exist because high-volume or exotic currency transactions require an exponentially higher degree of compliance oversight and specialized handling that retail branches are neither equipped nor staffed to manage. Recognizing these tiers and the internal firewalls between them is paramount. This awareness prevents you from expending time and emotional energy at a retail branch that is structurally incapable of helping you and eliminates the false expectation that a standard teller can resolve a complex foreign exchange issue. When your notes are valid and authenticated, the goal shifts from accepting a no to proactively searching for the specific internal pathway that aligns with your asset and documentation profile. If you hold authentic, verified notes and your primary banking institution still refuses to process them, your next strategic pivot is to explore the network of specialized institutions that have been specifically designed to handle the complexity of exotic currencies. By 2025, leading global banks maintain exclusive, high-security divisions focused solely on foreign currency operations, including the IQD, VND, and ZWL. Access to these elite divisions is rarely a walk-in procedure. It typically demands strong prior verification of the notes, comprehensive documentation of the source of funds, and, in many cases, meeting specific minimum financial thresholds to justify the specialized compliance effort required. These are not general service centers, they are highly controlled financial gateways. Moving beyond traditional banks, a critical resource is the emergence of professional redemption centers. These centers now operate in major U.S. financial hubs and function under extremely strict regulatory compliance frameworks. They are fundamentally different from a retail bank. These specialized centers coordinate a meticulous multi-step process. They require secure, scheduled appointments. They utilize biometric identification for security. They deploy advanced authentication protocols. And they maintain secure, verifiable communications directly with issuing central banks like the CBI, SBV, and RBZ. It cannot be overstated, these are not walk-in cash operations. They serve only vetted clients who meet rigorous, documented compliance requirements. This infrastructure is the higher infrastructure pathway that Rejection from your hometown bank is signaling you to find. To successfully locate these specialized pathways, savvy investors must utilize precise search terms and leverage professional networks. Resources that can guide you include specialized queries like CBI-affiliated institutions near me, or VND Redemption USA 2025. As global demand for high-compliance processing continues to rise, it has become increasingly common for highly prepared investors to schedule their required verification appointments weeks or even months in advance. The core realization for the modern investor must be this: a rejection from your local general-purpose bank does not mean the opportunity has vanished. It simply means you must transition your focus and assets toward these higher infrastructure, specialized compliance pathways that are structurally designed to handle the unique demands of exotic currency redemption in a regulated world. In the heavily regulated financial environment of 2025, the significance of impeccable documentation cannot be overstated. It is the absolute essential element for successful processing. The majority of notes that are ultimately rejected are not declined because of an issue with the physical note's authenticity, but rather because the corresponding compliance paperwork is incomplete, inconsistent, or missing. Proof of purchase is mandatory and non-negotiable. Whether the currency was acquired from a certified currency dealer, an established foreign exchange broker, or a major exchange provider, the investor must be able to provide original receipts, transaction logs, or digital confirmations that link the notes directly and verifiably to the current holder. This traceable provenance is critical for the institutions. Identification requirements have also been significantly enhanced. Modern compliance protocols mandate the presentation of multiple forms of identification, typically including a valid passport, a government-issued driver's license, and matching tax identification information, such as an SSN or TIN. For any large-scale transaction, the required documentation package may escalate to include a sworn affidavit, notarized forms, or formal declarations confirming the absolute legality of the holdings and the source of the funds used for purchase. For complex currencies like the Zimbabwean issues, additional disclaimers are often required, acknowledging the transitional nature of the notes and the lack of a guaranteed official redemption value. Banks and specialized redemption centers rely on this exhaustive documentary trail to shield themselves from regulatory liability. An organized, complete, and verifiable paper trail dramatically increases the approval rate and speed of processing. In this modern environment, compliance is no longer an afterthought. It is the mandatory gateway to moving forward. Financial analysts who closely track global monetary trends view the current worldwide wave of rejections and high compliance hurdles as far more than just administrative friction. They interpret it as a definitive signal of larger, structural shifts underway. Macro strategist Jordan M. Whitaker has described this phase as an essential cleansing of the financial system, a necessary preparation before major currency system reforms or large-scale valuation shifts can be safely implemented. The central banks are proactively and methodically eliminating counterfeit risks, invalid notes, undocumented currency, and external vulnerabilities. This systematic purification is happening globally, anticipating the next phase of the world's financial architecture. Evidence of this systematic preparation is visible in multiple parallel initiatives worldwide. Iraq's strengthening of its financial compliance systems under the terms of IMF Article 8, Vietnam's cutting-edge CBDC, central bank digital currency pilot rollout, and Zimbabwe's strategic introduction of asset-backed digital instruments all point toward a definitive future financial architecture. This future system will demand an unprecedented and uncompromising level of transparency, compliance, and disciplinary rigor from all participants. The systemic turbulence being observed in 2025 has been compared by historian Dr. Amira Sadate to the unsettled post-World War II landscape that immediately preceded the foundational Bretton Woods Agreement. She notes that those individuals who grasped the deeper structural mechanics during that historical period went on to shape the next half-century of global finance. She argues that those who understand and adapt to the structural shifts occurring today are positioned for a similar potential advantage. If your local institution issues a rejection for your authenticated IQD, VND, or ZWL notes, it is imperative to remember that alternative, compliant pathways remain fully available. One established route is through licensed currency brokers, who operate under the strict regulation of FinCEN or state money transmitter laws. These brokers offer safer, fully documented, and market-aligned conversion services. Many investors prefer the broker pathway because it generally offers quick settlements and provides robust compliance support with clear audit trails. For immediate, small-scale liquidity, airport exchange hubs can offer a partial solution for small denominations, though these transactions are typically executed at less favorable exchange rates and should not be considered a primary strategic pathway. A niche outlet for specialized or obsolete currency series is the community of private collectors who may purchase notes with historical or numismatic value. However, this route is highly variable and requires caution, as it is outside the regulated financial system (BR). The most structured and secure alternative is the use of formal redemption agreements. These are specialized, legally governed contracts established with vetted financial intermediaries. Such agreements prevent ambiguity by outlining preset exchange rates, specific authentication requirements, defined timelines, and clear compliance obligations. Regardless of the chosen method, the consistent theme is that utilizing reputable, licensed channels and maintaining immaculate documentation are the only effective ways to protect your asset and ensure a compliant transaction. Global observers recognize that the year 2025 marks a definitive transitional moment for international monetary systems. The world of finance is shifting away from simple, single-reserve currency dependency and is moving toward a highly complex, multi-asset, multi-currency, and digitally verified settlement structure. Key indicators of this monumental shift include the IMF's push for modernized foreign exchange reporting, the BRICS nations' increasing cooperation on digital currency initiatives, the rise of commodity-backed settlement frameworks, and the increasing use of blockchain-based audit layers within central bank operations. This decentralization of global reserves is a foundational change. The banking stabilizations in Iraq, the rapid digital finance expansion in Vietnam, and the asset-linked currency experiments in Zimbabwe are not isolated events. Each is a distinct, integral piece of a much larger, global mosaic of change. Economist Jared Brooks forecasts that undervalued emerging market currencies are poised to take on expanded roles in regional trade agreements, supply chain finance, and cross-border credit structures by 2026. This means that the investors who are engaged and prepared today are not merely participating in a speculative activity. They are strategically positioning themselves to play a role in this fundamentally evolving global monetary environment. Understanding this macro context reframes the entire discussion. While the feeling of rejection from a bank teller can be immediately discouraging within this broader, sophisticated context, that rejection often serves to push investors towards stronger preparation and access to superior resources. Holders of IQD, VND, and ZWL must consciously look past the immediate barrier and recognize the massive global patterns that are shifting beneath the financial surface. Success in this environment is not achieved through speculation or impulse. It comes from a rigorous commitment to note verification, meticulous documentation, comprehensive institutional research, and precise, disciplined execution. The modern monetary landscape is designed to reward those who respond to challenges with strategy and disciplined preparation, rather than with raw emotion or frustration. Rejection from a local bank should never be viewed as a final verdict. It is, more accurately, a directional indicator guiding you away from general-purpose retail banking and toward a more secure, fully compliant, and optimized pathway. The current era is defined by monumental financial transformation, and those who adapt quickly, maintain their vigilance, and prepare thoroughly will be the individuals best positioned to benefit as the sophisticated financial world of tomorrow takes its definitive shape. Your journey is not over at the no, it has simply begun its strategic phase. Once your notes have been professionally authenticated and the specific foreign currency policies of your initial institutions are clearly understood, the next, often complex step involves navigating the layered architecture of the 2025 Global Redemption Network. This new financial era has fragmented the banking landscape. Institutions no longer function as uniform gateways. Instead, each participant operates within a tiered ecosystem, its capabilities governed by its specific partnerships with foreign central banks, the digital settlement providers it employs, and the sophistication of its internal domestic compliance teams. This structural evolution means that the well-informed investor must consciously shift from passive, hopeful inquiry to a system of strategic, hierarchical navigation to successfully redeem their holdings. In this advanced financial architecture of 2025, elite financial institutions generally operate three distinct levels of exotic currency access, which every prepared investor must understand. Level 1 consists of the standard, everyday retail branches. These branches offer only basic foreign currency services and almost never process complex notes like IQD, VND, or ZWL due to internal risk protocols and a lack of specialized equipment. The staff at this level are trained to triage the request and redirect the client, not to resolve the transaction. Level 2 comprises specialized regional currency hubs. These centers house dedicated foreign exchange officers, possess enhanced, high-security authentication equipment, and maintain secure communication lines with international partners. They are designed to handle moderate volumes and are accessible only to pre-vetted, established clients. The highest tier is Level 3, the Specialized Redemption Divisions. These are reserved exclusively for high-volume, fully documented investors. These private divisions operate within a strict audit environment. They coordinate directly with the specialized legal and operations teams of the CBI, SBV, and RBZ, and they frequently integrate with advanced settlement rails like Ripple, the Swift Ledger, or private blockchain systems for transaction finality. Entry into this elite tier demands comprehensive purchase documentation, full compliance clearance, and often digital pre-registration and appointment scheduling. Understanding these institutional tiers is critical. It prevents unnecessary delays and eliminates the fundamental mistake of expecting a retail branch to process high-risk foreign currency notes. The strategic move involves actively expanding beyond your primary bank. If your home institution proves unable or unwilling to process your authenticated notes, the next mandatory step is to transition into the Specialized Institution Network, SIN. The SIN is the fundamental backbone of exotic currency operations within the 2025 financial infrastructure. These specialized institutions are typically concentrated in major U.S. financial hubs, such as the Dallas International Exchange Corridor, DX, the New York Unified Currency Center, NYU, and the Seattle Multi-Asset Verification Hub, SM. These centers are not retail operations. They are hybrid financial compliance facilities, part regulatory agency, part technological infrastructure, and part secured settlement platform. Each of these high-security redemption centers operates on a layered, rigorous intake process that includes biometric identification, tiered authentication protocols, blockchain timestamping of note verification, and dual operator verification for every transaction. Appointments must be meticulously secured weeks or even months in advance. Walk-ins are prohibited under all circumstances. Every single visitor and their holdings are screened through a pre-clearance process that includes sanction checks, a detailed source of fund audit, and required cross-border reporting protocols. Therefore, a rejection at your hometown bank is not a roadblock in 2025. It is a clear, definitive signal that you must now transition your focus and resources into the higher-order, specialized redemption architecture that has been purpose-built for this type of transaction. The most frequently underestimated obstacle for investors continues to be the completeness and integrity of their documentation. In the highly regulated 2025 ecosystem, institutions rarely reject notes because they are physically invalid. They overwhelmingly reject them because the accompanying paper trail is incomplete, inconsistent, or non-compliant. Modern redemption requires a comprehensive documentation package that goes far beyond a simple identification card. This package must include original purchase receipts, signed dealer certifications, bank transaction logs, and digital confirmations. It also requires valid government identification, such as a passport, real ID, or enhanced driver's license, and a verifiable tax identification match. For large positions, an affidavit confirming the lawful acquisition of the currency and a formal source of funds declaration are mandatory. Investors dealing with Zimbabwean currencies often require additional disclaimers that acknowledge their participation under specific post-collateralization exchange acts, which protect the institutions from liability during a transitional settlement period. For investors who have maintained meticulous, auditable records, these requirements are not burdensome obstacles. They are, in fact, powerful accelerants. Proper, complete documentation doesn't just support your redemption claim, it effectively places you into the fast lane of the 2025 financial compliance infrastructure, proving your legitimacy immediately. Financial analysts who monitor long-term monetary cycles argue compellingly that the current spike in rejections across both retail banks and specialized currency centers is not a system failure but a vital preparatory signal. According to macro strategist Jordan Whitaker, the visible turbulence observed in 2025 accurately reflects a necessary systemic purification that must occur before the next phase of global financial realignment can take hold. In his view, the legacy banking systems are being forced to aggressively purge all counterfeit risk, eliminate undocumented notes, and rectify all lingering regulatory blind spots before new valuation models or international settlement frameworks can safely emerge and be implemented. What appears to be resistance at the retail level is, in fact, often the earliest and clearest indicator of a coordinated, profound structural reform taking place far above the ground-level perspective. Tangible evidence of this structural trend appears across multiple regions. Iraq's persistent regulatory strengthening under its post-Article 8 framework, Vietnam's advanced digital dong pilot and CBDC exploration, and Zimbabwe's experiments with asset-linked digital instruments all point toward a collective future monetary model. This model will demand unprecedented discipline, transparency, and compliance from all participants in the global financial market. Historian Dr. Amira Sadat draws profound historical parallels, comparing 2025's currency volatility to the profoundly unsettled years that immediately preceded the foundational Bretton Woods Agreement. Then, as is true now, nations were globally rebalancing their reserves, redefining international trade rules, and recalibrating currency valuations. Dr. Sadat argues that the individuals who accurately understood those deeper, less obvious financial mechanics in the mid-20th century ultimately shaped the next half-century of global finance. She believes the same dynamic is at play today. Those who can clearly read the emerging patterns and shifts early will strategically position themselves to benefit most profoundly from the financial systems that inevitably follow this period of turbulence. Therefore, alternative pathways remain open, but they require precision, discipline, and documentation. If your local bank branch rejects your IQD, VND, or ZWL, it should rarely be interpreted as the final conclusion of your journey, but rather as the beginning of a higher-level strategic maneuver. In the rapidly evolving 2025 financial ecosystem, multiple parallel pathways have been established to provide compliant liquidity. Licensed currency brokers, regulated under FinCEN or state money transmitter statutes, are a primary option. Brokers provide strong, market-aligned liquidity, backed by robust compliance structures. This route is often favored by investors because settlements are typically fast, digital records are clear, and the necessary audit trails are preserved intact. A second, highly limited option is airport exchange hubs. These centers offer quick access for small denominations, though they operate with wide spreads and limited acceptance capacity. These hubs are best utilized as emergency liquidity centers rather than strategic, large-scale redemption channels. A third pathway is through private collectors. Collectors may be interested in purchasing obsolete, historic, or unique note series for numismatic value. This route, however, is high variance and requires extreme caution, as it operates outside the conventional regulated financial system. The fourth, and often the most structured option, is redemption agreements. These are formal, legally governed contracts established between vetted intermediaries and the investor. These agreements are crucial for minimizing ambiguity in a complex environment, as they outline preset exchange rates, specific authentication requirements, strict timelines, and clear compliance obligations from all parties involved. Across all these pathways, the key differentiator for success is the quality and completeness of the documentation. Bar. Global observers tracking broader monetary trends describe 2025 as a decisive hinge point in world finance. The foundational architecture of the global economy is definitively shifting away from a reliance on a single reserve dependency and is moving toward sophisticated, multi-asset, multi-currency, digitally verified settlement structures. This change is not speculative, it is happening now. Indicators such as IMF-driven modernization of foreign exchange reporting, the BRICS nations' digital currency cooperation, the rise of commodity-backed settlement models, and the increasing decentralization of global reserves are all clear evidence of this profound transformation. Iraq's banking stabilization efforts, Vietnam's expansion of digital finance, and Zimbabwe's asset-linked currency experiments are all independently functioning, yet interconnected, parts of this larger mosaic of change. Economist Jared Brooks forecasts that by 2026, undervalued emerging market currencies may assume significantly larger roles in regional trade agreements, supply chain finance, and cross-border credit structures. The essential conclusion is that the current market turbulence and regulatory tightening are not signs of weakness or failure. They are the necessary preparation for a new and more disciplined global system. Ultimately, rejection is not a wall, it is a signpost. Hearing the discouraging phrase, "We don't accept that currency should never be interpreted as a dead end." Within this broader, fictional framework, The refusal functions as a precise directional indicator, explicitly pushing investors toward better, more disciplined documentation, stronger, more specialized institutions, upgraded verification methods, clearer compliance routes, and more strategic decisions. Today's monetary environment is designed to reward discipline, not impulse, strategy, not emotion, and structure, not pure speculation. Those investors who adapt quickly, maintain their rigorous documentation, understand the complex institutional pathways, verify their sources with professional services, and diligently study the global monetary patterns are the individuals best positioned to participate meaningfully as this fictional monetary world shifts into its next foundational phase. In eras of such transitional magnitude, the prepared do not simply react to change, they are strategically positioned to benefit from its inevitable outcome.